Welcome to today's market analysis of the Nifty 50. Today, we're going to break down the price action from July 16, 2026, and use data-driven insights to plan for the upcoming session on July 17th. Our goals are to understand exactly what happened in today's range-bound session and to prepare 3 actionable scenarios for tomorrow. Before we dive in, if you find this analysis helpful, please like and subscribe to Index Orbit. For live data of the option chain and real-time analysis, I highly recommend using the Dhan trading platform. You can use the referral code EJZZI96380 when opening your DMAT account on the Dhan app to get started. Let's start with a high-level summary of the session on July 16th. The Nifty 50 closed almost flat, down just about 6 points. It was a classic indecision or doji day. The market opened near 24,072, rallied up to test the 24,180 zone, but was quickly sold into. It then dropped to test the 24,000 support before recovering to close almost exactly where it started. Notice the implied volatility, or IV, is quite low at 1133. This tells us the options market isn't pricing in any massive moves right now. The put-call ratio of 0.83 suggests a mild call dominance, giving the market a slightly bearish to neutral tilt. To understand why the index remained flat despite some strong sectoral moves, we need to look at the heavyweight stock behavior. Here is the performance of top Nifty-weighted stocks. HDFC Bank was down 0.67%. Reliance was up 0.02%. ICICI Bank 0.45%. Bajaj Finance leading at 1.56%. TCS 0.96%. ITC 1.12%. And L&T down 0.45%. Under the surface, market breadth was actually constructive. The IT sector led the way, with stocks like HCL Tech up over 2% and TCS up nearly 1%. Autos and Bajaj Finance also showed strength. However, the index was capped because its heaviest component, HDFC Bank, fell 0.67%. Reliance was essentially flat, offering no support to the bulls. This tug-of-war between strong IT stocks and weak heavyweights resulted in the sideways movement we saw in the index. Bank Nifty also struggled, closing down 0.30%, weighed down by HDFC Bank, Kotak, and Axis Bank, even though some PSU banks held firm. Notable laggards outside the top weights included Zomato, which dropped nearly 3%. Now, let's look at the big picture on the daily candlestick chart. Looking at the price action from the last few sessions, we can see a clear pattern emerging. Earlier, Nifty rallied into this supply zone between 24,400 and 24,600. Notice the long upper wick on that rally, followed by a large bearish candle. That is a classic rejection and distribution signature by smart money. Since that rejection, price has been consolidating just above this demand zone at 23,884. The current price is sitting right in the middle of a range between 24,000 and 24,200. This is textbook equilibrium behavior. In smart money concepts, we look for liquidity pools. Buy-side liquidity sits above 24,200, where short sellers have their stops. Sell-side liquidity sits below 23,884. Where long positions are protected. Often, the market will sweep one of these levels, meaning it wicks through them to trigger stops before making a real move. Keep a close eye on these boundaries. To refine our outlook, let's analyze the open interest and the option chain data. This is where the big players place their bets. As mentioned, the put-call ratio is 0.83. In the world of options, we often look at this as a contrarian indicator or a gauge of sentiment. Here, it shows that call writers are slightly more aggressive than put writers. Take a look at the strike prices. We have a massive put wall at 24,050. This acts as a strong immediate floor because put sellers are aggressively defending this level. On the flip side, we have a call wall at 24,200. This represents heavy resistance. The market is essentially trapped between these two walls. Looking at the change in data today, we saw fresh put writing building up between 23,920 and 4,050. Meanwhile, call writing was reinforced from 24,150 all the way up to 24,500. This tells us that the resistance is getting stronger, capping any immediate upside unless these call writers are forced to cover their positions. Based on the price action and the data we've analyzed, let's map out the critical levels for the Nifty 50 on July 17th. You should have these marked on your charts. Starting from the top, 24,600 is our ultimate ceiling for this move. The major battleground on the upside is 24,200, which aligns with our max call wall. The current price is hovering just above 24,050. This is a crucial pivot. If we stay above this, the bulls are still in the game for a range-bound play. Below that, we have our primary demand zone starting at 23,884. This is the must-hold level for the medium-term uptrend. If this breaks, we could see a quick slide toward 23,700. Keep these levels in mind as we move into scenario planning. They represent where the smart money has placed their orders and where we expect the most significant reactions. Now, let's look at scenario A, which is the range or flat continuation. This is the most likely outcome for tomorrow, with a 55 to 60% likelihood. Why is this the most likely? Well, the low implied volatility of 11.33, a neutral put-call ratio, and the fact that max pain is sitting exactly at 24,100 all point toward a choppy session with very little follow-through. The game plan here is patience. Don't chase the candles when they are in the middle of the range. If you are an aggressive trader, you might consider range-bound strategies, selling near the top resistance and covering near the bottom support. However, for most directional traders, the best move in scenario A is to stay in cash and wait for a confirmed breakout of this range, with high volume. The market is currently in equilibrium. There's no need to force a trade when the data suggests a flat-as-usual day. Our second possibility is scenario B, a bullish breakout. We assign this a 20 to 25% likelihood. For this to happen, we need to see a sustained close above 24,200. That is our major call wall on rising volume. Critically, we need to see the call riders at 24,200, 24,500 start to unwind, or short cover. If they are forced to buy back their positions, it will provide the fuel for a move toward 24,400. Don't just jump in as soon as the price touches 24,200. Wait for a 30-minute candle to close above it and look for a retest of that level as new support. This scenario requires participation from the heavyweights like HDFC Bank and Reliance. IT stocks alone cannot carry the index into a sustainable breakout. If the price falls back below 24,150, the breakout attempt is considered failed. Like and subscribe to Index Orbit. Use Dhan trading platform for live data of option chain and analysis. Use referral code EJZZI96380 when opening the DMAT account. Finally, let's consider scenario C, the bearish breakdown. Like the bullish scenario, we see this as having a 20 to 25% likelihood. This scenario triggers if we see a decisive break below 24,000, and especially below the 23,884 demand zone. This would represent a sell-side liquidity grab. Triggers to watch: 1. Renewed selling in HDFC Bank. 2. Nasdaq weakness affecting Nifty IT. 3. Decisive break below 23,884. If this level breaks, the next major target on the downside is the 23,716 to 23,735 range. What to do? Wait for a confirmed close below 23,884. Not just a wick, enter on a retest of 23,884 as resistance. Invalidation. Reclaim back above 24,000. The key here is to watch out for wicks. Often the market will dip below a support level just to trigger stop losses before reversing. To avoid being caught in a trap, wait for a confirmed close on the 30-minute or hourly chart below the demand zone. If the market breaks down and then quickly reclaims 24,000, the bearish thesis is invalidated. Triggers to watch for this move include continued selling pressure in HDFC Bank or a sell-off in the Nasdaq, which could spill over into our currently strong IT sector. Like and subscribe to Index Orbit. Use Dhan trading platform for live data of option chain and analysis. To wrap everything up, let's review the key levels summary for the July 17th session. These are the markers that will define our trading day. Here is the breakdown of the major resistance and support levels based on price action and open interest data. The bottom line is that every signal we've looked at, the low volatility, the tight and reinforced option walls on both sides, and the indecision candles on the chart, statistically favors another range-bound or flat day over a major breakout. The 24,000, 23,884 levels are the absolute ones to watch. A confirmed close beyond either of these, backed by high volume and the participation of heavyweights like HDFC Bank, is what would flip this market into a directional move. Until that happens, 24,000 to 24,200 remains our operating range. We've now met our objectives of analyzing today's behavior, interpreting the data, and mapping out our scenarios. Remember to trade with a plan and strict risk control. If you found this analysis helpful, please like and subscribe to Index Orbit. Use the Dhan trading platform for your live data and analysis. You can find the referral code on the screen to open your account. Disclaimer: this report is a technical and data-driven read of publicly visible price and options data. It is not investment advice. Please consult a licensed financial advisor before trading. Good luck in the markets tomorrow.